Well, that's actually consistent with my expectations as to when they might pull back some of the quantitative easing. I thought that it was really notable that in the minutes, only one member said that they should really begin it immediately. But it seemed as though there was somewhat of a consensus that they could moderate the pace of tapering, if you want to put it that way, as far as that they could increase their asset purchases if economic conditions warrant. So it's actually fairly consistent with my expectations that they would begin moderating around the middle of the year and perhaps stop purchasing by the end of the year.
Well, the question is, of course, this was before the March jobs report was released. Does that change anybody's thoughts about how the Fed is going to react and maybe think that they were more hawkish in these minutes than they are today?
It is possible that it has changed since the meeting actually took place because of how bad those job numbers were. But I would point out that they were actually pointing out in those minutes themselves that a lot of the strength was coming from basically sustained consumer spending and the prospect for continued business spending. So obviously they were making mention of the labor market in the minutes, but I don't think that that one jobs report is really going to change anything. If anything, it will maybe delay by a month or a meeting perhaps as to when they actually begin to taper their asset purchases, but nothing really all that dramatic.
Now, Brian, does this alter strategy in any way? Because you're a buy-side firm. You invest across asset classes on behalf of other people. Does any kind of commentary from this change your fundamental view about why the investment environment is the way it is right now and what it'll be like in the future, Brian?
Well, thankfully for me, it doesn't actually change anything because it was consistent with my expectations. But I could see how some people might view these minutes as saying that the Fed might actually continue their asset purchases for a little bit longer than what was originally anticipated. If people were going in expecting that they were going to begin tapering at around, let's say, June, they might now be thinking that, well, maybe that'll begin around July because of those bad jobs numbers. And also, since the meeting, they begin to actually try to substantiate or put a little bit of meat around what they mean by what is a substantial improvement in labor market conditions, and we're nowhere close to being there yet.
Well, and then you wonder, and I know, Brian, you've talked about this, about, when that happens, if that means this so-called bond bubble is going to burst. And I wonder how you could actually see, what are the indications that actually might happen if we're getting these early indications from the Fed?
I think that what we might see is the Fed begin to tapering and actually markets beginning to move in anticipation of, let's say, around what the summary of economic projections are. So when the Federal Reserve releases those at every other meeting, people might key in on that and say, is the possibility of the Fed tightening coming sooner, or is it going to be coming later? And that could create a little bit of volatility in terms of yields, but I don't think we're actually going to see any sustained increase in yields across the board until the Fed actually begins raising that federal funds rate. It's basically what we saw in 2004 is that the Fed, they were so transparent with what they were doing, it didn't really take anybody by surprise. So as long as the Fed is very transparent and they haven't really begun to sustainably increase the federal funds rate, I don't see any prospect of yields moving significantly higher.
Well, here's an interesting thing. They do put out their summary of projections, including what they think is going to happen to interest rates. It's their famous bubble chart. And in 2014, 5 members of the FOMC think that interest rates, the Fed funds rate, not QE, but the Fed funds rate is going to be higher, with one person thinking it's going to be at 2.75%. Really? Then when you get into 2015, which is the year they've suggested they would start at least raising rates, that you'd get to the 6.5% unemployment rate, you've got all of them but one suggesting that interest rates are going to be higher in a range from 25, one person at 25 basis points, one person at 4.5%.
Wow.
So they think that you could go to 4.5% by by the end of 2015, one assumes. Now, the majority is clustered around about 0.5% to 1.25%.
So anyone who thought that this was going to be gradual, if you look at that, maybe there's a chance it's not going to be gradual.
There certainly is a chance.
Yeah.
But what about the transparency of this? I mean, they're putting all of this out, right? Is the idea that the Fed is telling us all of this stuff just so that we can temper our expectations or get used to this idea that we could have higher interest rates sometime soon without there being a shock to the overall market?
Well, can they do that, Brian? That's the question. Can they? Can they manipulate what you do?
Yes. Well, honestly, I think that they can, and it's actually the lesson that you can draw from, say, the 1994 experience versus the 2004 experience. 1994, so February 4th, 1994, first time they released a policy statement. It was so vague and opaque. Nobody really knew what they were doing. It sent everybody sort of in a tizzy as to what's going on in the fixed income market. Everything really sold off at that point. 2004, they were much more transparent. So maybe 2014 is going to be even more transparent. They're practicing what I would call like a WikiLeaks approach to transparency, where it's a radical transparency. They effectively want people to know what they've been having for breakfast in order to make some of these decisions, so you can key off with some of those changes.
Just to read all the tea leaves. And Dom, I mean, what I've been surprised though, you know, despite if maybe some of the traders had actually read closer into this report, like what Mike has just done, we'd see more selling. Right now, there's not much reaction in the futures.
You're not seeing a whole bunch of reaction, only because, at least for now, this program is still in place. These are expectations, and like Mike was pointing out, these things came out before the jobs number.
Yeah, I tell you, if we had had a strong, close to 200,000 jobs reported in March, we would be seeing a massive sell-off right now.
That's very
one
true.
thing I would point out, though, is you have to remember that the voting members are going to change. So the bubble chart and all that, that's for all of the participants. And so what you really need to focus on are who are the members, what are they expecting? They're the voting members, the ones who actually make the policy decisions.